Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
A lot more dollars are going into AI initiatives. The problem is it could potentially be coming, at least in the near term, at the expense of kind of increasing the increasing revenue trajectory for Salesforce. As far as Salesforce is kind of concerned, I think they're looking at AI, at least in the near term, as more of a headwind rather than a tailwind.
If the consumer is working and unemployment is still below 4% and the consumer is generally making more money, right? And we did see almost 4% wage growth last month, which continued a long string of wage growth that's higher than inflation. They're going to continue to spend. So I think, the rumors of the U.S. consumer's death are greatly exaggerated.
Q1 GDP growth came in slower than was originally estimated. Of course, there's still the forecast from GDP Now, Atlanta Fed, looking for greater than 3% growth in the second quarter. So I think we'll have to wait to see what transpires for the entire quarter. But I think tomorrow's PCE will be more important than this GDP report.
We've got 1 hour to go until the market close, so we're taking a look at the major averages right now. And indeed, as you just heard Sam Stovall say, people are watching tomorrow morning's PCE report. And ahead of that, they're selling stocks. So we have the Dow down once again today here. You see that more than 2% drop we've had over the past 3 sessions, and dropping again today by about 0.75%, about 289 points, 290 points or so today. The S&P 500 down about 1/3%, and the Nasdaq down about 2/3%. So we continue to see a little bit of a divergence between the major averages, but not as much as there has been in recent days. What's interesting is today's selling is coming even as there is a little bit of relief in yields. Remember, we've been talking over the past couple of days how 10-year Treasury yields have been creeping higher, reflecting that sort of higher for longer sentiment. Well, they're down today, down 7 basis points to 4.55%, but that is not bringing much relief to stocks today. So that's something to keep an eye on. Let's take a look at the sectors within the S&P 500 right now. XLK, the tech sector, infotech, is down the most, and that's really what's dragging things down because you got most of the other groups that are trading higher today. Real estate, utilities, materials, financials, all of them are trading higher, but we've got some of those big cap tech stocks that are trading lower here. You see some of them, some pretty significant declines from Microsoft, from Alphabet, Nvidia, Amazon, Meta. And then if we equal weight this so we can get a better look at what is selling off here, you see CrowdStrike, MongoDB, Adobe. A lot of software stocks are selling today. And there is one particular culprit, which is going to take us to our next topic. But I just want to check on it real quick here today because it has remained near the top of our trending ticker list. I'm talking about Salesforce with that 21% decline that we are seeing today, biggest single day drop that we've seen in 20 years. And Josh, we got to dig into that one.
Yeah, we will right now, Julie. As you know, shares of Salesforce are sinking today after the software company said sales growth will stall to its slowest in its history. So is this a long-term concern for investors or this just a bump in the road? Well, joining us now for an outlook on Salesforce is Dan Ives, Wedbush Managing Director and Senior Equity Analyst. Dan, great to have you on the show on set. Let's dig right in. I thought it was interesting, Dan, when you look at the stock, on the conference call, just some of the language on that call from executives, where they were sounding this note of caution, Dan. I mean, they talked about measured buying behavior. That was their words, not what you love to hear when you're an investor. What do you make of the tone? What do you make of the report and the reaction?
And Benioff calls it like it is, but they're in between 2 growth waves because the AI-driven growth, what I view as the renaissance of growth for CRM, that's still 9, 12 months away. So what's happening is you're seeing some disruption on larger deals. But in my opinion, it's a bump in the road. Because you'll see the overreaction like you're seeing on the sell-off. Remember, we saw the same thing with Palo Alto down 30%. Look what's happened in that recovery. I believe it's conservative bar. They basically cleared the deck for next quarter. And if you looked up sandbagged, guidance, you'd see this quarter coming up.
So there's a bump and then there's sort of a plateau, right? I mean, 9 months is a long time, potentially, for investors to be patient when they're looking at a payoff that isn't coming till next year, maybe even the year after. And it seems like today, there's not a lot of patience baked in.
Yeah, no doubt. Look, patience wears thin because you have the haves and have-nots. You got the godfather of AI, Jensen, Nvidia in the left lane. Do you bet on that and just pay up? Or any sort of sniff of any negative news, Workday, Salesforce, we've seen across the board, you're going to see this happen. But in my opinion, you're talking about a gold standard tech play, one of the best installed base in the world, AI on the doorstep.
With a ton of data.
Yeah. Growth coming back, and we'll call it 10%. Now they've cleared the decks. To me, it's a table pounder moment in Salesforce. But like we see, many from an analyst perspective or investors, they're going to hit the elevators in this type of environment. But to me, it's the time to really own a gold standard name.
Do you think, listen, Mark Benioff, veteran, tested, has been in the game, I don't know, what, 20, 25
Mount
years?
Rushmore of
Mount
CEOs.
Rushmore. When you see a stock crater like this, though, Dan, it's not unreasonable, probably for some investors to say, okay, look at that, it's nosediving. Is he still the right guy for this job as they make this transition you're talking about?
I mean, you're talking in that Mount Rushmore. I mean, you got Jensen, Cook. You put
Mr. Mark Benioff
I
on
put Benioff, McDermott. I mean, so the point is, if he's flying the plane, I'm in 3A, feeling really comfortable watching Netflix. And the point is, this is a situation where they have it all in front of them. And I just view this as it's a speed bump, not the start of a structural decline. I think we sit here 6-9 months from now, and this is potentially a historical buying opportunity for Salesforce.
I just want to press you on this a little bit more. Okay, so let's take your plane analogy. It doesn't matter how good a pilot you are if the turbulence is bad enough. And they kept saying on the call over and over again, measured buying behavior, which is code for our clients are not spending as much, right? They're in a retrenching environment. So even if Salesforce itself is in a transition and things are going to get, it's going to get the company in a better place 9 months from now, what's to say that the buying environment is going to be any better?
And just to continue on that point, it would be going through 30 minutes of turbulence, knowing you're landing in Kona. Okay, so the point, my view is that on the other side of that is the fourth industrial revolution, the 1995 moment.
In Kona. I mean, that's where you want to.
we want to be there.
Big Island, some could say Maui, Kauai, but the point, we don't want to get into that. But my view is that when you're looking at the AI revolution, you're looking at the second, third, fourth derivatives, Salesforce front and center, which is why to bet against Benioff, it's like betting against the Rangers in the playoffs.
Benioff, he did have those activists circling, right? But he gets to work, he gets religion. Where do you see margins headed from here?
I think that's it. Free cash flow is increasing. So you look at margins are actually upticking. They raise guidance from an EPS perspective. Now look, in this type of market, any negative news, stocks are going to get hit like this and overreacted. I believe we sit here weeks, month from now, we look at this and be like, look at the recovery, because the investors that maybe missed, because remember, if you go back 18 months ago, New York City cab driver was bearish in Salesforce, activists, 10 downgrade, look what happened to the stock. I think we go through, again, a Groundhog Day situation there, and if someone's leading it, and I'm betting on Benioff.
I want to ask you about M&A for a sec, because he sort of was a little bit coy when it came to more acquisitions on the call. They wouldn't address Informatica directly. Should investors brace themselves for another large-scale acquisition attempt on the part of Salesforce? And would that be a good thing?
Look, initially it would be negative and dilution. We saw that with Slack, which I think has continued to plague the company a bit. But Julie, at the end of the day, we're talking about a Game of Thrones playing out in tech. And what that means, as you look at AI, you're going to see M&A consolidation continue to, I think, accelerate. So this tip of the iceberg to what I see is just a massive phase of consolidation. And Benioff, the deal maker, is not going to be on the outside looking in. If a deal comes through, that makes sense. But to that point, they're not going to be compelled to just do any deal. I continue to believe that deal, if we're talking about A, B, C, D, that's a B- deal.
The Informatica deal.
If an A+ deal comes and the valuation's right, maybe on the private side, then Benioff, ultimately one of the best poker players out there will do that. But for an informatic, I don't see it.
Get you out of here on one thing. I need to get a Dan Ives vibe check on Palantir because they're making news this week. Deals $480 million contract with the DoD. You still a fan?
It's the Messi of AI. To me, it's really one of probably the best pure play AI name out there. That thing got way oversold on earnings. And now, as you see Karp and what the team's doing, they're just executing brick by brick. I think it continues to be probably the most underestimated AI play, maybe tech play in the market today.
All right, Dan, we got to talk about something outside of tech. Because a lot of people saw the New York Post has named you the best dressed man on Wall Street. Obviously, very distinctive for what, and you know, Josh and I have known you for a while. You have ratcheted it up through the years. You have turned it, and you kept on turning.
Look, this has been, and you know, we've known each other for a decade, a phase sort of approach.
It's the evolution, like Salesforce, really.
It's
yeah,
like
that's what it really is.
It's essentially, it's like going from perpetual to subscription model.
And you know what? And you land in Kona. That's what it looks like.
And you land in Kona.
You would look very
like
at home
Kona.
in Kona, I
That's
think.
what
And it's true. Look, you know, as I talk about in the article, it's always trying to sort of have a vibe where, you know, I don't know what I'm going to wear in that day, but it gives me a more relaxed feel. And it's one where, you know, I think many, you know, see how I dress, and also it takes down a notch some of the seriousness in a very serious industry.
Yes.
Bring down
I like
the tone.
that. You got your
like
shades too.
I got my shades, and look, and again, I'm just trying to follow the lead of you and Lipton in terms of, you know, where this
Maybe
is all
we can.
headed.
I don't know.
I mean, like, I
Josh,
think
maybe you could have a little more fun, Josh.
Maybe I'm just too conservative. It's too serious. But gotta lighten this whole thing up. That's the problem.
I know, but I go here. S&P hit 6,000. Lipton's wearing a purple sports jacket.
I'm in.
I bet when S&P hit 6,000, I bring my purple sports jacket and Lipton.
Oh my
wears
gosh,
it.
I love this.
Done?
It's done. It's a
That's
date.
good television.
Okay.
Financial
we'll do
analyst and television producer, right there.
That's what we're doing.
That's what
Dan
it is.
Ives, thanks for coming in. Great
Thank you.
to see you. We are just getting started here on Market Domination. Hard to believe we can top that, but we do have a lot coming up for you. Okta shares are seeing a dip despite beating first quarter earnings and raising its full year guidance. We're going to speak to the CEO about those numbers on the other side. Okta lifting its full-year adjusted earnings forecast after topping first quarter estimates. However, the company says it's taking, quote, a prudent approach to guidance amid a challenging macro environment. Here to discuss is Okta co-founder and CEO Todd McKinnon. Todd, it's great to see you. Thanks for being here.
Thanks for having me on, Julie. It's great to be here.
So, Todd, I'm really curious to get your sort of temperature check on that macro environment. You know, we have been talking a lot about Salesforce today. We've been talking about the enterprise spending environment. What are you seeing in your business?
I think there's definitely some headwinds in the macro environment, particularly if you compare it to a couple of years ago where the environment and spending and scrutiny of deals and so forth was quite frothy. I think we're seeing a more measured approach now, particularly in our business in the small and medium business sector. On the positive side, though, in the large enterprise sector, we're seeing good momentum. The $1 million plus cohort of customers is our fastest growing segment of customers, and it's been that way for a few quarters now. So I think there's some economic prudence and measured spending environment, but overall, we're seeing pockets of strength as well.
So Todd, if the macro's kind of choppy here, how are you all responding? What levers are you pulling to navigate that?
Well, there's all kinds of tactical and executional things, and it's lost on this. I think the companies that can do well in this kind of environment are the companies that are good at just down and dirty execution. They're good at communicating with customers. They have good customer relationships. They're selling basic things that work and provide value for customers, and we're trying to get that back to basics playbook and doing an effective job at that. And then also you have to be providing something that's going to be valuable despite what's going on in the broader economy or what's going on in the tech trends of the moment. So right now everyone's figuring out what they're doing with AI, and guess what? Identity management plays a role in AI. We're the login for OpenAI's ChatGPT. And all of these new AI services are going to need login, and they're going to need security, and all the new tools that enterprises deploy to their workers are going to need great security and great login. And we're going to be right at that nexus between people and technology. And so we're very relevant in any environment.
So, Todd, you guys did raise your forecast, but a lot on the street are calling it conservative. How hard and fast, I guess, should they take that forecast? Can they expect potentially some upside?
Well, we look at it in both terms of length. So in the short term, we're being prudent, and we think that given some of the macroeconomic choppiness, our guidance is prudent, and it's justifiably so. But in the long term, we're very bullish. We think that the entire tech market and the entire identity management market is a massive market. Every company needs identity for their employees, for their customers, and they need to make sure it's all secure. And more, identity is the key to security. And so in the long term, we're very bullish on our total addressable market opportunity and our ability to address that over time.
Todd, I got to ask you if you think there's been any kind of lingering fallout from that October security incident, because it sounds like, Todd, what you're saying is, no impact to the installed base. I'm wondering if you think, though, there's been any challenges because of that to acquiring new business.
Yeah, we're one of the most attacked companies in the world, and because of the critical role we play in the technology ecosystem. And every month we block about 2 billion cyber attacks against us and our customers. But in October, we did have an issue, and we're working really hard to make sure that we address the concerns customers have. And more importantly, on a go-forward basis, we're leading the industry in the fight against these kind of identity-based attacks. We call it the Okta Secure Identity Commitment. And that messaging is really resonating with customers because they want a vendor they can trust, but they also want a vendor they can learn from. And as we go through the process of hardening our corporate infrastructure and making sure our products are secure by default, our goal is to be the model that every customer will expect of all their vendors. And we're off to a good start, and we're dedicated to continuing on this journey to make sure we're the most secure company in the world.
Just to push on that, though, Todd, listen, you all have competition. It's Microsoft, it's smaller vendors. I'm just curious whether you think that breach gave your rivals, your competition, an opportunity there to capitalize.
Well, I think competitively, it is very important that we execute well and that we differentiate from the competition. I think a couple of things we have going for us there. One is that some of the competitors you just mentioned have had their own breaches, and just demonstrating that how difficult it is when you're a prominent leader in an industry, how much you have to focus on it to stay robust and secure. And then also just how the hardening process that goes through something like Okta, being an industry leader for years and years and years, how robust and secure the company that's been tested can demonstrate and come out at the end of it. It's pretty differentiated, especially from competition that's smaller or more of an upstart that hasn't gone through that hardening, and we're seeing that resonate with customers as well.
Todd, I know most CEOs we speak to say, oh, we don't pay much attention to the stock price, but it must be somewhat frustrating.
They're lying.
To come out, yeah, exactly. It must be frustrating to come out with these numbers. You see the stock drop. You guys are down a little more than 2% year to date. What do you do in a situation like that? If they're lying? Tell us what you're thinking about it.
I mean, you do have to think about what's going on in the business that's contributing to that long-term journey and that long-term path. I started Okta 15 years ago, so there's been a lot of ups and downs. And I take a step back and I think to myself, in this last quarter, we signed a very significant deal, 7-figure deal in the public sector with part of the U.S. Department of Defense. And I think to myself, 5 years ago, 10 years ago, 15 years ago, imagine signing something like that. And it really keeps you grounded in what's possible over the long term. And although you do look at the stock price and you definitely rather have it go up than go down, you can take a step back and see big milestones like that. You get excited for the next 15 years.
Todd, thank you so much for taking the time to join the show today. We appreciate it.
Happy to be here. Thank you.
Checking in on some of today's top trending tickers, UiPath sinking today as the software company issued some weaker than expected revenue guidance for the second quarter. The company also announced an executive shakeup as CEO Rob Enslin is resigning effective June 1st. He's being replaced by co-founder Daniel Dines, who stepped down as co-CEO on January 31st. So this one takes a hit today, Julie. Disappointing forecast, surprise departure in the C-suite. Evercore's Kirk Materne, longtime tech analyst who knows software as well as anybody, saying the combination there is going to not only pressure shares in the near term, but likely now throws path into show me mode for the foreseeable future. Did maintain his inline rating, but cuts his target to 13, down from 27, so a big cut. Says this is a multi-quarter process in terms of realigning sales comp and getting back to just steadier ground.
Yeah, that was something that was echoed by William Blair's Jake Roberge, who says he downgraded it too, and he said it could be a year of transition for the company because of those execution issues. What does this company do, by the way? It makes automation software, so like repetitive tasks, it automates those tasks. And I think, the theme that we see emerging today in the companies that we're talking about, whether it's a Salesforce, whether it's Okta, is this idea around discipline, around spending from companies. And so it seems like, this one is sort of macro and micro. It's stuff that the company is doing. But it's also the macro environment
your
that
point
is challenging.
It's really well taken. I mean, we're just talking about with Salesforce, this kind of concern in the enterprise software industry about just this spending pressure from corporate customers, and you're seeing it again.
And then there's a hardware company that we're watching today that's doing pretty well, and that's HP. Those shares are higher after the PC maker came out with numbers that beat estimates, and also came out and said it was going to continue to do a little better. We're seeing maybe a little bit of an inflection point here. Of course, we heard from Enrique Lores, the CEO, as well, and he didn't want to get too sort of run away. The transition is here. But it seems like investors kind of took it that way in terms of the PC trough and recovery. The printing business is still not doing great, still seeing year-over-year declines. But it saw its first PC increase in PC sales for the first time in a couple of years.
Yeah, I mean, it's sort of, there's been folks banking on a recovery there in PCs, and I think HP's given them some hope. New version of Microsoft Windows software, new PCs with AI chips, as you noted, Julie. CEO Enrique Lores telling our own Brian Sozzi that about 10% of PCs sold this year will be of the AI variety, but then he does see that ramping to 60% in 3 years, so some real bullishness there. To your point, the printing business under pressure.
Yeah.
They did introduce a subscription plan for printers, and I think Lawyers was also talking to Sazi about that he sort of indicated that's showing some success, some traction.
And by the way, we're waiting for Dell after the close of trading, which is going to be really interesting. That one has been running into the earnings until today.
Move.
The stock is down a bit today, so we'll see what happens.
Moving on, stocks sinking ahead of the close today as concerns about higher for longer interest rates put a damper on investor spirits. New York Fed President John Williams may be easing some concerns, saying he expects inflation to start coming down again in the second half of the year. For more on the Fed's path moving forward, I want to welcome in now Bob Elliott, Unlimited co-founder, CEO, and CIO. Bob, it is great to see you. So why don't we start there, Bob? So, John Williams did make some headlines today. He did say inflation is still too high. Goes on to say, Bob, I don't feel any urgency or need that. I don't feel any urgency or need that we have to make a decision now, he said. What do you make of those comments, Bob? What do you make of where the Fed goes from here?
Well, I think given all the noise of the commentary, people often think that the Fed is likely to be more active in terms of shifting its policy mix than the reality. Most central banks, when they've been on pause for an extended period of time and aren't seeing meaningful shifts in the macroeconomy, the way that the Fed is seeing now, inflation still a little too high, underlying growth still pretty good. The inclination is to pause and do nothing and gather more information. And I think that's basically what we've seen through the whole slew of these Fed speakers over the course of the last couple of days, where basically all of them are pointing to the fact that it probably makes sense to just wait and see. Some of them are hoping for lower inflation. Some of them are maybe concerned that it might be a little bit higher, but wait and see is the key theme across all of them. And that means that, a meaningful cut cycle is probably not going to happen this year.
It's so interesting, Bob, because, a lot of market participants have sort of come to that view, despite whatever Fed funds futures are pricing in at one moment or another. We talk day in and day out about, the market is moving on this piece of data that the Fed is watching or this Fed speak. But like a lot of people we're talking to are saying it doesn't matter if they cut this year. Stocks are almost agnostic to the Fed at this point. Do you think so?
For a period of time, it looked like stocks are agnostic, particularly at the beginning of the year as rate cuts came out and stocks rallied. But the key reason why that happened was that we had a resetting of growth expectations in the economy from coming into the year of below 1% growth to now expectations are that growth in the second through fourth quarter is going to be something like 3%. Each quarter on an annualized basis. That's very, very strong growth. Unlikely that we're going to achieve growth at quite that pace through the end of the year, combined with the fact that the Fed not delivering those cuts is going to put pressure on the bond market, discount rates, which is also a drag on stocks. And so I think we've transitioned. really, after the first quarter, we've really transitioned to a point where a lot of the market action in stocks is really being driven by the bond market. And we've seen that, for the last couple of months.
Bob, I want to get your take on another trend, too. There's an interesting piece in the Journal today, Bob. I never saw it. Title was, "This Record Stock Market is Riding on Questionable AI Assumptions." Goes on to say how just 4 giant tech stocks added more market value than the rest of the SPX put together this month. Just generally, Bob, I'm interested to get your take on that AI trade. How confident, how bullish are you on it?
Well, I think days like today highlight just how sensitive the equity markets in aggregate are to the big AI trade. If you look at sort of the average stock, it's doing fine today, and the big stocks are dragging down the overall market. And so that highlights the fact that we do have a big trade on AI in the market and very, very elevated earnings growth expectations that come with it. If you look at the overall market, expectations are for 17% earnings growth at the S&P 500 level over the by the fourth quarter, 17% year-over-year earnings growth. That is extraordinarily high for an economy that has nominal growth of about 5%, 5 or 6%. The only way that that's going to happen is with these large AI players and large tech players gobbling up corporate market share and being able to increase their margins, and that seems like it's going to be challenging to meet those expectations. And, the feeling that we're getting today may be a more common occurrence over the course of the next 6 months.
So then, Bob, what's sort of your best play right now? Where are you looking, if not necessarily to add an AI-related stuff? Where are you going?
Well, there's across the equity market, it's a challenging environment to find things that look like they're of good value in the market relative to what's priced in. There are certain places that still look like they have some opportunities. The financials look to have some opportunities, and so taking advantage of some dips there is a place that is still so underpriced relative to the AI boom. And that's really the primary area where I would be focusing on right now, given a bit of the sort of structural pessimism that has persisted in those assets for a while.
Bob, always great to have you on the show. Thank you, sir, for joining us.
Thanks for having me.
In our latest edition of Goodbye or Goodbye, we're taking a look at real estate. As any home buyer knows, it's all about location, location, location. That's after this break.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. And today we're taking a look at real estate and which markets within the U.S. are best positioned to grow in the months and years to come. I'm joined by Richard Anderson, Wedbush Securities Managing Director of Equity Research. Thanks for being here. Appreciate
Thanks for having
it.
me.
So talking REITs here, and let's start with your stock that you prefer. It's called Camden Property Trust. And despite the name, The properties are not necessarily in New Jersey, for example.
They are not in Camden.
No, they are not in Camden. So let's take a look here at what you like about this company. And indeed, you look at short-term exposure to excessive supply. What does that mean?
So Camden is largely invested in the Sun Belt area of the United States. Lots of new supply of multifamily housing coming online right now. So in the present tense, Camden might be arguably a difficult name to own, but what we do know is supply is going to start to hockey stick down in the months and quarters and years ahead. And if you're already long that space, as Camden is, that should be a real good period of time. So in the present tense, it's easy to say, I'm not so sure about Camden. In the future tense, and in the very near term, I'd say this story really starts to pivot.
And to be clear, these are rental properties
Rental
that they're
properties,
okay.
yep. Mm-hmm.
And when we look at the South, you're looking at growth. Now we have seen growth already in the Sun Belt, and you think we're going to continue to see that kind of growth?
Oh, by all means. The jobs move to the Sun Belt, in-migration trends to the Sun Belt. There'll be more in the way of capturing market share of new home or household formations because people simply can't buy a home. This is true of all of multifamily rental, by the way, to take market share away from the single family marketplace because it's simply not affordable. So even in higher interest rate environment like we're seeing today, multifamily should be, a reasonable place to invest. And we think that that'll be the story for the the months and the years to come.
Let's talk about the short part of the hockey stick when it comes to supply, because after this ramp up, you think generally in the market there's going to be tighter supply.
Right, and that's good if you're a REIT because you're not facing the type of competition that you are now of all this new supply coming online. It's essentially a competition for that next renter. And so for now, the REITs are having to cut rents or offer concessions to compete against that brand new development happening across the street. As that goes away, the growth profile of Camden gets really exciting next year, and that's why we like it.
Interesting. All right, we always like to talk about what a risk could be for a stock like this. And in this case, it's that you see a contraction or the job growth is falling.
That's true, and to use an analogy like my friend Dan Ives does all the time, cholesterol is supply, but Lipitor is demand, and demand comes in the form of jobs. Demand for multifamily housing, and so to the extent we lose that edge of job growth to just generally in the United States, but also moving into the Sun Belt, that would be a problem to our thesis. So we're not expecting that, but that's the risk.
Okay, gotcha. So let's get to the stock that you like less, that you don't like as much here, and that's another REIT called IXIC Property Trust. Now, first of all, it's got a very different geographic profile, right? It's mostly, if not all, on the West Coast, yes?
All on the West Coast, 85% in California, 15% in Seattle.
Gotcha. And those folks are working from home a lot more.
That's part of our problem here, right? So IXIC is a fine company. It trades significantly higher than Camden does. It's kind of the tech play in multifamily, if I could say that. 41% in Northern California, 15% in Seattle. And so you have days like today with Salesforce, and things can get whipped around in terms of it being a read-through. And so I'm not a tech analyst. I want to kind of focus on the real estate, and so that's why I think Camden is perhaps a better call. IXIC is a different story entirely. It's not a supply issue.
Yeah, let's talk about the job stuff a little bit more, because as you talked about the growth in the Sun Belt, the flip side of that for this company is tech jobs.
That's
and
right.
Anybody who's looked at the headlines over the last year knows in a lot of segments there has not, at least hasn't been the growth. In some cases there's been cutting.
Right. And so we know that with the tech layoffs and sort of the slowness to rehire, we know work from home is something that's a little bit more allowable, I guess, let's say it that way. But people move out of California all the time too. The job growth that we're seeing in California is largely government, low-wage service, not the types of people that you might rent an apartment from IXIC property. And so it's a question mark, let's put it that way.
Are they higher-end apartment properties?
Well, anyone in the REIT space that owns sort of the cream of the crop is going to demand the best of the best in terms of their tenancy. They're very focused on credit, and they don't want to lose people for whatever reason. So that's.
All right, and then the last thing here is lacking major future recovery thesis. what's going to happen next?
Well, so we have this, we called it a hockey stick, right?
Yeah.
This decline in supply that should benefit Camden, that is non-existent with Essex, right? I'll be wrong if we get some sort of major hiring trend in tech and everyone's going back to work and all that sort of stuff. And that day comes, we may flip this thesis. But for now, we don't see that recovery opportunity nearly as much as we see with Camden.
Yeah, and I guess, again, like we talked about the downside risk for Camden, the upside risk for Essex is that you do see a big increase in AI-related demand, right?
Right, and so to the extent that starts to sort of fill the void in terms of jobs the types of people that can live in an Essex property, then yeah, our thesis may sort of pivot. But for now, I think there's a lot of questions around. You have a day like, again, today, where there's a lot of questions in the market, and Essex is sort of the poster REIT, if I could put it that way, for that type of situation.
Yes. Do you have positions in either of these?
I do not.
Okay. Well, Rich, thanks so much for being
Thanks
here.
for having
really
me.
interesting stuff. Appreciate it. So you're telling investors to buy Camden property. On the other side, you say avoid Essex. Thanks so much for being here. Appreciate it. And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
All right, let's get to our call of the day. Mizuho upgrading PayPal from neutral to buy while also raising its price target on that stock to 90. This is from Mizuho's Dan Dolev. Bottom line, Dan likes this company's fast lane offering, which speeds up the process of guest checkout. That's really kind of the theme of the call. He thinks this could drive as much as a $1.5 billion boost to PayPal's transaction margin dollars. That implies, he says, 5 to 10% upside, Julie.
Yeah, I mean, that's really the whole call here today. He says there has been stabilization in branded checkout trends as they analyze the big e-commerce partners for PayPal. And also that the valuation looks good right now, that the company is trading at a historical discount to its peers, and that then as Fastlane sort of ramps up, that should reverse and get better. I mean, you talked about the numbers here. I always love a good TAM, don't you? Total addressable market. He's talking about $3 trillion in total addressable market for Fastlane alone. And he says 1.4 trillion of that is realistically addressable. Like PayPal could sort of get at that somehow.
Yeah, it talks about new data showing less pressure on branded business, so meaning its core checkout button, as well as strong early trends in Fastlane. Also says mobile checkout trends seem to be getting better. Says that's notable as mobile is where the secular pressure has been more accentuated. The stock is basically flat for the year, but Dan clearly seeing better times ahead.
Yeah, and there is some hope centered around Alex Chriss, who is still the relatively new CEO of the company. Let's take a look at another ticker that's trending today. That is Dollar General. The shares are slumping. Now, initially, they went up after earnings, but now the stock is down by 9%. The CFO saying the company anticipates that consumers will continue to be price sensitive throughout 2024. Some of that commentary coming on the earnings call, and that there will be in a more promotional environment, perhaps. So, sales mix headwinds, she said, are going to be greater than previously expected. So after, the company's numbers initially looked pretty good, and then they started making that commentary on the call, and that seems to be what sent the shares lower.
Yeah, and they did just maintain their guidance for fiscal 24, Julie, and they talked about sounds like they talked about how it's going to be harder to kind of book profits with higher costs, and they are doing, things like store remodels. And they got plenty of competition. I mean, more retailers have kind of been pushing into their world.
Right.
Their rival Dollar Tree reporting next week.
Yes, indeed. Although Dollar General, sort of more food, more staples that people are continuing to buy there to some extent. One other thing I want to mention as well is that the company also talked about shrink, so-called shrink, basically theft here, that they are trying to take more actions to improve shrink, and that things should be better in the latter part of the year, but that improvement might come later than expected. So that also seemed to weigh on the shares.
Yep, for sure.
Well, coming up, inflation-weary consumers are hungry for a deal, and competition between fast food chains is heating up. Who is best positioned to come out on top? We'll discuss next.
McDonald's addresses viral social posts and media reports on the company raising prices significantly beyond inflationary rates. The fast food chain defending its commitment to value and affordability, a key ingredient other fast food companies are getting their hands on. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Peter Saleh, BTIG Managing Director, and Andrew Charles, TD Cowen Managing Director, join us now to discuss. Guys, good to have both of you on the show. Peter, maybe I'll start with you. We can start kind of high level, Peter, as you kind of look across your coverage universe, the fast food chains, Peter, you know inside and out. How healthy, how resilient does this industry look?
So look, I think the industry is healthy, but I think they are going through a tougher time right now. Lots of discounting. You're seeing it from McDonald's. I think this is just the beginning. I think you're seeing it from Wendy's. You're seeing it from Jack in the Box. You're seeing it from Burger King. And I think this is going to continue. And I think these discounts, as steep as they are going to likely hurt same-store sales in the medium term. And I think they could hurt margins. In our opinion, these are investments in value perceptions, given all the media backlash against all the price increases that have been happening. So we think this is something necessary, a necessary evil for these companies to be doing at this point in time. But it's going to take some time to change the perception and the narrative in the media that these companies are more about value than they are about price hikes.
It's really interesting. I mean, price wars, we haven't seen in a while, right? Because of this inflationary environment. Andrew, is it going to work? Are consumers going to gravitate to those chains where they see promotions?
Thanks for having me. So we're cautiously optimistic, but I would say the last time we saw this, to your point, was in 2018. Not a banner year for McDonald's. You had same-store sales of about 2.5%. It's a little bit above the consensus right now for 2% for the year. And during that time, traffic was negative by about 2.2%. So the analog here is not great. I think that the numbers are achievable, though, for McDonald's based on this strategy. And so, we're optimistic that this can be met. But, McDonald's did rescind their guidance or their outlook for 3 to 4% U.S. same-store sales. And obviously, this tactic likely wasn't contemplated at the beginning of the year when they issued it.
And Peter, back to you. McDonald's, big in the Lipton household, Peter. I mean, that 5-year-old... You give her an Oreo McFlurry, she's good to go. Let's get some of your top picks, though. Domino's Pizza, Peter, walk me through why you think that's a buy right here.
Yeah, so Domino's is our top pick, the only QSR that we are bullish on. And it's a self-help story. They got several initiatives that they're working on or that are going to drive same-store sales, and they're very company-specific. First of which is the change in the rewards program, which really happened September of 2023. So that gives them a benefit. Really, it carries through the full year of 2024, and they're already seeing increases in transactions across the board with that change. And then when you look at the change in the Uber Eats partnership that they added, at the beginning of this year, that is starting to add some incremental sales as well. They think they'll exit the year close to 3% sales mix. The vast majority of that is going to be incremental this year. And then they can layer on top of that in 2025, adding on DoorDash and other partnerships as well. So I think they have a lot of self-help initiatives going on that'll drive, that mid-single-digit same-store sales growth, and that's why we're bullish on them.
And Peter, how is pizza viewed in the sort of value chain, right? Do you think consumers say, oh, am I going to go to McDonald's or am I going to order a pizza? And that pizza is viewed as a good value proposition?
Yes, I do think pizza is a cheaper alternative in terms of feeding a family of 4, probably for like $30. Can't do that these days at any of the other QSRs. I don't know that pizza is necessarily taking share from these other fast food players at this point. I don't believe that to be the case. I do think pizza just continues to grow at a very low single-digit rate. Will continue to grow at that rate. But I do think it's probably one of the better value propositions out there in the quick service space.
Andrew, I'm looking across your coverage universe, a number of buys. One hold that sticks out to me is Wendy's. How come you're on the sidelines there, Andrew? And what would you need to see to get more bullish?
Yeah, we're worried about McDonald's share gains, from this. if we go back to 2018, Wendy's and Jack in the Box were two names that noticeably McDonald's gained share from. Taco Bell is noticeably one name that was able to gain share in the 2018 environment. So, part of it reflects that, and part of it reflects the fact that they're trying to march towards a more sustainable growth rate, for the company of that 2 to 3% range. We're a bit more concerned on their ability to do so, given high interest rates. Given that it's been a challenging cash flow story for franchise operators for the last several years. Unfortunately, Wendy's we don't think is immune from that. And the fact they've missed their development targets in recent years as well leads us to believe that there's better opportunities elsewhere versus Wendy's.
And Peter, back to you for a sec here, because you recently upgraded Darden. I know, not exactly in the same category, but talk to us about what you're looking at in that situation.
Yeah, so for Darden, we view it as a best-in-class casual diner. I think you've seen same-store sales trends improve as we've gone through this year from January through February, March, and into April. We think they will benefit from that. I do think they have levers to pull if they so choose on promotions and advertising, given that they've reduced that level by about 200 basis points since the pandemic. I also think they can be a great beneficiary of the weakness over at Red Lobster. Red Lobster announced the bankruptcy a couple weeks ago. They closed about 100 stores. Darden or Olive Garden and Red Lobster share a parking lot in about 400 locations. There's a lot of overlap there. We think a weaker Red Lobster is a benefit to Olive Garden, and so we went ahead and upgraded shares of Darden.
Andrew, we were just talking about Wendy's, and of course, they made all kinds of headlines for dynamic pricing. I'm just curious, Andrew, that issue, dynamic pricing, is that a real potential change you could see kind of ripple through the industry you cover?
It's interesting. You think about dynamic pricing. I mean, when you look at the delivery platforms, the Uber Eats, DoorDash, et cetera, typically you see about a 20% markup there. And so I would call that dynamic pricing. I think there was a PR snafu when Wendy's messaged what they were looking to do. It seemed like it was a bit misinterpreted, but they eventually backed off what they planned to do. So I think it would have to be handled delicately. Certainly third-party delivery makes a lot of sense. That's a convenience-based occasion, not a value-based occasion, where restaurants can charge more. I would be curious if we think philosophically, though, about the industry, that restaurants in general talk about how the best prices and deals are available through their app. So it kind of fits your point just about the dynamic pricing, that it just has to be done in a way with finesse. But I think there's absolutely a way for this to be done, and a way that restaurants are looking at this. I think the word choice will be a little bit different, though.
Well, and that sort of comes back to something you said in the beginning, Peter, which is messaging around that dynamic pricing, around pricing generally. McDonald's recently pushing back against that sort of viral thing that said that there was the $18 Big Mac or whatever. Do you think that they've learned some lessons? Are they doing a better job?
So for McDonald's specifically, I don't know that, they haven't taken an outsized amount of pricing. It's just strange as to some of the reports out there that prices were up 100% or more since the pandemic. It's just, it's not true. Most of these quick service restaurants have taken a high teens, low 20% increase over the past, 4 or 5 years. Pretty consistent across the industry. So not sure where those numbers are coming from, but clearly when the discrepancy is that wide, they needed to push back and clarify a little bit. And I think they did a good job of doing that with the letter that they put out.
Guys, good to see you. Thanks a lot.
Thank you.
Peter Saleh and Andrew Charles. And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings from Dell, Costco, Zscaler, and more. And plus, we've got a conversation with Gap CEO Richard Dixon.
And at 4:30 Eastern Time, it's the latest edition of Asking for a Trend. Got you covered with the biggest market-moving stories affecting your money. Stay tuned. More market coverage after this.
That is the closing bell on Wall Street, and now it's market domination overtime. So let's get you up to speed on the action from today's session. It looks like the major averages closing at the lows of the day. The Dow now off 330 points, down 0.9%. We've been watching that three-day pullback down by about 2.5% in that period of time. The S&P 500 off 0.6%. But today it is the Nasdaq that is the loser of the day, down more than 1% when all was said and done. And there is primarily one culprit here when you're looking at this, and that culprit is Salesforce. Here we've got your heat map looking at the various software companies, and we really have seen this big sell-off in software. Down by 20% today alone is Salesforce, and that's as the company's growth is effectively slowing. And there are a lot of concerns, as we've been talking about today, about what is happening with enterprise spending. Is all of the money flowing to chips, for example? That's certainly where the investment dollars have been flowing. And are we not seeing as much spending on things like Salesforce's software? Now, we heard from Dan Ives earlier in the hour that this is just a speed bump. Maybe it'll last 9 months for the company. It's a transition period, and it'll come out of it. But today, investors are not terribly patient, and it's taking the stock into the red for the year. Today's decline, by the way, is the biggest single-day drop in about 20 years for Salesforce shares. But what's more, we are seeing really a broad-based selling that was triggered by Salesforce here. Microsoft down 3.4%, Oracle down 5%, Adobe down, ServiceNow, one of the other worst performers on the day in the S&P 500, down 12%, CrowdStrike, Snowflake. You get the idea. There are just a few pieces of green on this screen here today. So a lot of it having to do with that ripple effect, Josh.
Julie, stocks trading lower today. That's as investors digesting today's first quarter GDP revision. That number shrinking to 1.3% from the initial reading of 1.6%. Our next guest thinks this points to an economy that is gradually feeling the effects of Fed rate hikes. For more, we're bringing in Ed Clissold, Chief U.S. Strategist at Ned Davis Research. Ed, it's good to see you. So let's start there, Ed. Get some economic data today. Q1 GDP growth comes in slower than expected. What did you make of that, Ed? It did seem like consumer spending is holding in there, Ed.
Yeah, for example, if you look at real final sales to domestic purchasers, which is a mouthful, but it really is a good trend for the consumer, it was still well over 2%, only slightly below its long-term average. So the consumer is doing okay. There still is that mix from goods back to services, which is going on, which affected some inventory. So there's some moving around of some of the data, but the underlying trend is okay, slower than it was for the second half of last year. But I think it does get us closer to maybe what the Fed was looking at, which was potentially an economy that's slowing down some and would give them room potentially to lower rates 50 to 75 basis points over the next year.
Ed, as I was just talking about, we've seen a bumpy few days for the market, right? Part of that has to do with that thinking about rates being higher for longer. We had seen bond yields go higher, but they didn't go higher today, and stocks still fell, which was kind of an interesting phenomenon. As I just talked about, Salesforce was part of that. But I know you've been doing some work recently on bond yields versus stocks. What is that telling you about sentiment around yields?
Yeah, so you think about it in an inflationary environment, say from the late 60s through the late 90s, stock prices and bond yields were inversely correlated, which means bond yields go up, stocks go down. Inflation was the big concern. So higher inflation meant, inflation's coming, the Fed's going to raise rates. Once we got past that Asian financial crisis in the late 90s, up until just a couple years ago, it was the opposite. Higher bond yields were good because deflation was a bigger concern than inflation. So higher yields meant better economic growth, but you didn't have to worry about inflation getting under control. Well, now that we're in this new inflationary environment, it's the opposite. The correlation between stock prices and bond yields is negative again. So day to day, something might happen, but really what this means is the market's concerned about bond yields. Bond yields can't go up too much. That could be the killer for the bull market if bond yields break out.
Ed, let me ask about another trend you saw, as we kind of made our way through this earnings season, Ed. You talked about that, the return of shareholder capitalism. More companies, when they were getting their results, Ed, they were delivering this capital return news. We all like receiving a check in the mail. What did you make of that trend, Ed? What does it tell you about the market, where we are and maybe where we're headed?
I think it reflects a confidence among corporate America that the cash flows they generated over the past year are going to continue to grow and perhaps even accelerate modestly this year, quarter over quarter. Look at, say, the dividend growth for the S&P 500 was only 4% last year. That's half the average since 2010. Actually, net repurchases were down 14% last year. So the big increase we've seen in repurchase announcements and actually purchases themselves in Q1 is a good sign that a lot of companies feel better. And then if you look at the companies that are doing most of this, it's really remarkable. These are the same companies that are doing big AI investments. On the one hand, they can invest billions into a new technology. On the other hand, they can return a lot of capital to shareholders. So it's really remarkable what they're capable of doing.
And Ed, I also know you've done some work on breadth as of late. Now, breadth seemed to be broadening out, right? It wasn't just the so-called magnificent, however many we're talking about these days. But maybe that's been narrowing once again. What does that tell us about, stocks' room to run further from here?
Yeah, well, I love your magnificent whatever, because that's the challenge of people just going to pick whatever stocks they want, which isn't great research. But what we've seen over the past year or so is a broadening, then a narrowing, and broadening again. What you don't want to see is a consistent pattern of divergences. That is, popular averages making new highs, but percentage of stocks above, say, their 50-day, 200-day moving averages not making new highs. And that's what we saw in May. If you look at a lot of breadth gauges, they did not get as strong as they did in March, even though the Dow, S&P, Nasdaq made new highs. Look, it's early. This is just a few weeks. This could resolve itself, and most of the time these divergences do resolve themselves in a bullish way. But we need to keep an eye on this, because this is how market tops form.
Well, we'll see if that's what this is. Ed, thank you so much. Hope to catch up with you again soon.
Likewise. Thanks for having me.
We got to get to some earnings here. It's Dell. The shares are down a quick 8% here, and that's after the company came out with earnings that seem to have beat estimates by and large. Now, adjusted earnings per share came out at $1.27 versus the $1.23 that analysts were anticipating. Revenue also beating estimates. Adjusted operating income seems very slightly shy. And the Infrastructure Solutions Group, that's where there's been a lot of attention on the company, that it was benefiting from the AI boom. That coming out ahead of estimates as well, $9.23 billion versus the $9.06 billion that was estimated. So it's not immediately obvious to me why we are seeing the stock down the way that it is down. I'm trying to take a look at the press release, as I know you are as well, Josh, to try and figure out what's going on here.
Yeah, at first blush, I agree. It looks like earnings look decent. I do wonder, listen, expectations were red hot. I know the stock was down a bit today, but heading into this print, this was up over 250% over the past 12 months. Investors had moved in because they had clearly decided Dell is an AI winner. A lot of interest about AI, new AI services, and that has meant demand for Michael Dell's AI servers. I'm just trying to check one bogey I was looking for, Julie. Interested to see what they said about the backlog for AI servers, because last time they reported, they said that was 2.9 billion. Now it looks like they say that. I'm just trying to look through here. I'm going to keep trying to find out, because I wanted to see the comparison year over year.
Yeah.
It looks like that backlog is now growing to more than 3.8 billion for those AI optimized servers. So looking through, I don't know if this is a question of expectations, but still trying to find out where there could be some disappointment, obviously, in the print.
Yeah, and especially because the stock also pulled back today. Although, to your point, it is done, it's more than doubled this year, up 123%, yep, even with that small pullback today. And Bloomberg analysts pointing out going into this report that the stock is trading at 19 times earnings. Going into its last report, it was trading at 16 times earnings. So it has gotten more expensive as that price has gone higher. So we're going to keep an eye on that one. It's been kind of a good old Dell. It's become a buzzy stock. It's
remember the
Nvidia
happens. Connection as well. You have to say Nvidia at least once every show. So that's why I'm trying to get in.
I
but
know.
It was interesting because Dell has this relationship with Nvidia, and Jensen Huang recently talking about praising the company.
Yes.
High praise from Jensen.
Yeah, I believe that he was at their conference.
Correct. Called him right out.
And spoke at that conference. Yeah, for those of people playing the Nvidia drinking game at home.
There's one.
There's one. I think we've already said it a few times, probably.
Sure.
Let's talk about Zscaler as well. That company also coming out with its numbers. Those shares going in the opposite direction, up about 7% right now. Let me run through the numbers for you. There we have also a revenue and an earnings beat last quarter. That's its fiscal third quarter. 88 cents, handily beating the estimates, and revenue also ahead of estimates here. The company saying in the fourth quarter that its earnings per share are going to be above what analysts had been anticipating here. And it looks like its revenue forecast for the fourth quarter also leaves it room to beat estimates. So a little bit of a different situation, right, than we have seen with some of these other enterprise companies as of late here. So I'm going in. It looks like billings were up 30% year over year as well. And this is another cybersecurity firm that we are talking about here. And the company said basically that everybody's talking about their go-to-market teams lately. Have you noticed that? Salesforce talked about that.
Snappy sounding term. I would use that.
What does go-to-market mean,
Sounds
Josh?
great.
Doesn't it just mean sales?
It looks like.
Isn't that what it means?
You know what it sounds like? It sounds very professional and slick. Something I'd buy into.
I think it just means their sales. Everybody's looking at their sales teams right now. So Jay Chaudhry, the CEO of Zscaler, says they're building a strong go-to-market team to scale our business to $5 billion and beyond in annual run rate. So, there you go.
You saw some headlines. I think this one, there were some articles about a security breach, and would that lead to some growth worries? But initially, right here, nice pop for the stock.
It's like Todd McKinnon of Okta said. Everybody's got a security breach now. Yes, we have one, and it's bad.
Yeah.
But when your competitors also have it.
Who doesn't?
I guess I don't know what that says about our world that we're living in. I do know what it says about the world we're living in. Nothing good. Let's get to one other outside of software, and that is Ulta Beauty. Now, Ulta, remember, came out and lowered its numbers recently and really took a lot of people in the market off guard. Well, guess what? They're coming out again and lowering their forward-looking numbers. The share's down about 2% right now here. So let me run through it. First quarter comps did beat estimates. Comparable sales rose by 1.6%. Earnings per share beat estimates, and net sales came in line with estimates. This is for their first quarter. The company is coming out with a full-year forecast here, cutting it. Full-year comparable sales going to be up 2 to 3%. They had seen an increase of 4 to 5%. And it looks like the operating margin forecast is going down as well, as is the earnings per share forecast. Now, the thought had been that beauty was actually, kind of performing relatively well. And so when they came out and did that negative guidance, that was a hit to that perception, and this is a further hit.
Yeah, these remarks were made at a JP Morgan conference last month, and it was kind of suggesting this deceleration, and that maybe the management had been kind of caught a bit by surprise by the trends. And so not surprising, Julie, investors not feeling terribly confident, and you've really seen this stock not work. It's in the, heading in here in the red over the past 12 months. It's already down about 20% so far this year. So it has been really beaten up, and you were down here, at least initially, about 1.5%.
Yeah, and the CEO, Dave Campbell, acknowledges that things are tricky here, and he said basically they adjusted the annual guidance as we anticipate the dynamics we faced in the first quarter to continue for the balance of the year. Yeah, there we go.
There you go. Coming up, let's move on. We've got the latest earnings from Costco and Gap, plus a conversation with Gap's CEO. Stick around. More market domination over time. That's coming up.
look now at shares of Gap after reporting first quarter results, jumping. The company boosting its full year outlook. That's really what's going on here. And, you know, people have long been waiting for a turnaround for Gap. CEO Richard Dixon is the relatively new guy at the helm there, and he's been trying to right the ship. And this showing signs of working. And see adjusted earnings per share beating by a wide margin here. Comparable sales rising 3% year over year. That's better than estimated. Gross margin coming in at 41.2% last quarter. That is better than estimated. And you got to look at the breakdown in the comps of the different brands. All of them better than expected. Old Navy up 3%, Gap up 3%, Banana up 1%, and that reversing a decline. Athleta up a much better than expected 5%. So all of them better than anticipated.
Rocketing higher. It was such an interesting, like, pull out the stock chart, just sort of interesting to look at, because heading into this print, it had a very strong run, Julie. It's up about 160% over the past 12 months, but year to date, it hadn't done as well. It was about 6%, but clearly tacking on here. And I think, yeah, you're right, all eyes are on Richard Dixon, you know, relatively new CEO, formally took the reins last summer, and just, I think we're always looking for more color and commentary about his strategy, progress for the brands, which looks like it's getting some traction, and he's being rewarded for it.
Yes, he is indeed. I'm just looking also, because I'm always curious when I see a movement like that in the stock. Short interest,
yeah.
You know, that's where I look. About 14% of the stock is floated according to Bloomberg data. So pretty high, but still, you know, it was also just a good quarter and good news that they're raising the
Let's
forecast.
listen, you know, more on that.
More
quarter.
color,
Julie,
as
right
you
now.
said. Yes.
Yahoo Finance's executive editor Brian Sazi had the chance to speak with Gap CEO Richard Dixon on the better than expected first quarter results and what to expect from its flagship brand. Take a listen.
We had such a good, strong quarter, exceeding expectations again. We had 3% comp growth on top line. We had margin expansion, both gross margin and operating margin expansion, and we did it off of 15% less inventory. I think it's also really important to recognize this is our 5th consecutive quarter where we grew share. And what it's doing for us, it's really indicating that customers are responding well to our brand reinvigoration efforts. You know, we've talked about it before. Reinvigorating this legacy portfolio of awesome brands has been an incredible opportunity, and the culture that we have now that's really driven to unlock that potential is really gaining momentum. It's also the first time that all 4 of our brands have reflected positive comps, and that's in many, many years. So look, there's a lot to be excited about. We're on stronger financial footing, our brands are resonating, and really we're just getting started.
Richard, I've been following Gap for like 20 years. Full disclosure, I've never actually seen results like this from the company. I mean, I know you're almost a year in, but I mean, hat tip to you on this stuff. But I think one of the biggest stories that the street might catch on to, it seems like the business is being better run. You mentioned inventory down 15% against sales comp increases in all of your brands. Where is this inventory going? And did you just hit the reset button and say, we don't want to be selling some of this stuff in our brands, let's clear it out, let's start all over again?
Look, I think it really ladders up to our strategic priorities. You know, what we talk a lot about, and I'm relentlessly repetitive, both inside and outside the company, is where do we need to be focused? The first focus of our business is maintaining and building upon the financial and operational rigor that we have started to demonstrate that's really showing up over the last year and ultimately really showing up in our numbers. It's just about a much more disciplined approach to running the business. It is allowing us the ability to start to concentrate on reinvigorating our brands. And that's the methodology that we've talked a lot about, which is our playbook. So between maintaining financial and operational rigor that's showing up on the scoreboards, it's allowing us to start to really dial up our reinvigoration strategies. We're strengthening the operating platform, supply chain, technology, culture, media, marketing, and ultimately energizing our culture. So it's not a silver bullet. Rigor is showing up in every part of our branded portfolio. And the productivity that we're driving is obviously the metrics that we're enjoying right now. But we've got a lot of work to do. You know, we're very pleased. We're taking a very quick victory lap, but it's not a sprint, it's a marathon.
This is the second straight quarter where you blew away earnings estimates. Clearly, the street is underestimating a lot of the operational rigor you have put into the team, and I would argue what's happening on the top line. Does the street just need to forget that pre-you, old Gap is dead and there's something new and potentially special happening here?
Look, we are in it day to day. We're driving what is a legendary portfolio. It's got extraordinary history. We talked a lot about the history of our brands. There's been what I'd call strategically well-intended initiatives over the last many years, some of which execution-wise was flawed. Despite all of that, we have extraordinary brand recognition. We've got fandom out there with people who love us. And our mission, if you will, is to drive more relevance and revenue through a culture of creativity. And we're seeing the early stages of those successes. In the context of the relationship both inside the company and outside, we're as transparent as it gets. We've got work to do. We're diligent in the priorities that we have, and we're executing with excellence. And the scores on the board are there. And most importantly, our customers are reacting. Measuring ourselves with market share gains, recognizing this is a tough industry. In a declining industry, we are actually growing. That is a great indication that our work and reinvigoration is working.
In the limited time that we have, Richard, maybe let's look upon each brand. Let's start with Gap. I've seen Gap recently on red carpets with Anne Hathaway and taking photos. I've seen photos of Zach Posen, who leads now design for you all. Over the next few months, what should we expect from that brand? Are more red carpets at play? And what will the apparel that Gap is selling look like?
So thank you, Brian. I really appreciate it because Gap is our flagship brand. It's our namesake. It's the original brand that started our extraordinary company. We are making incredible progress. Certainly, we're demonstrating, as I've talked about, operational and financial rigor, but we're seeing the proof points show up in our reinvigoration playbook. As we've shared, this is another positive comp, 3% in the quarter. That's our second quarter in a row of comp growth. And so we're really encouraged with what I'd call getting our vibe back. You've seen our first big campaign, Linen Moves. It is a great example of Gap, I would say, having a voice in culture again. I mean, we turned linen, which is a summer fabrication every year, we turned it into a big idea. We drove it with compelling in-store merchandising, extraordinary digital execution, and our sales in linen are double digit versus last year. We're going to continue to lean into this through the summer. You're going to see a lot more product, a lot more variety. And as I've said before, Gap is a pop culture brand. We've been showing up in the cultural conversation. Besides, the linen campaign, you mentioned it, our Met Gala dress, which was worn by Dave Vine. Obviously, Zach is, a brilliant designer who, with Dave Vine, created this extraordinary presentation of how denim could be worn couture. We followed up with incredible attention with the shirt dress worn by Anne Hathaway. We also had a great collaboration with Doan, and all of this is driving relevance and revenue. And Brian, we're just getting started.
Lastly, let's just zero down or zero into Old Navy. How does Old Navy plan to win the back-to-school shopping season?
First, Old Navy, it's the largest brand in our portfolio. So we're spending a lot of time working diligently on what I call reasserting the brand's authority. Old Navy, it's the #2 apparel brand in the country. We've got a huge, important fleet of over 1,200 stores. We've got an extraordinary online presence. As reported, we reported a strong quarter. Sales are up 5% and comps up 3%. This is the third quarter of positive comps. It's also the fifth quarter of market share gains. So we're feeling really good about where Old Navy is headed. We've had particular strength in women's, where we've been really focused on reasserting, both from a product and a marketing perspective. Active has been another category that we've strategically intended to grow, and that's been showing up on the scoreboard. So look, we're looking at Old Navy on a day-to-day business, executing with excellence, ensuring that we become, if you will, the brand's authority in style and value. Quarter by quarter, we'll share our results, but we're very excited with where we're headed.
And we've got more earnings out on the retail front. Costco, the shares are sliding despite beating on the top and bottom line. Taking a look here, it looks like total comp sales, including gas and currency effects, were up by 6.6%. If you exclude those effects, still up by 6%. Both of those beating estimates. Revenue at $58.5 billion ahead of estimates. And earnings per share about 8 cents ahead of estimates at $3.78. But nonetheless, the shares are down. They did rise in today's session going into these results here, and they're also up year to date.
Yeah, always, listen, it's a fun read into the consumer and an insightful one. And so it'll be interesting to hear what color and commentary we get there, gas, groceries, non-food, like jewelry. I do think you sort of hit on one important point there, Julie. There was some talk from some quarters about valuation on this one hanging into the print, given the kind of run the stock had.
Yeah, and we keep waiting to see if they're going to raise their
membership fees. It's been years.
Which they haven't done in a long time. And in this economy, as Kyla Scanlon would say, maybe they can't do that. We'll see. Yeah.
All right. Time now for To Watch, Friday, May 31st. Let's start off with the economy. All eyes, of course, on tomorrow's PCE print, the Fed's preferred inflation gauge. Economists forecasting both PCE and core PCE to hold steady at 0.3%. April's reading giving us more insight on potential rate cuts from the Fed. New York Fed President John Williams saying today that inflation does not need to be exactly at 2% to cut rates.
Jury deliberation continues for a third day tomorrow in former President Donald Trump's hush money trial. The charges are tied to an alleged hush money payment made to adult film actress Stormy Daniels toward the end of the 2016 presidential campaign. So we'll see if we do get that verdict. And then what? That's really the interesting question. Yeah.
That'll do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, it's our new show asking for a trend. Stay tuned. Hello and welcome to Yahoo Finance's brand new show, Asking for a Trend. I'm Josh Lipton, live from our NYC headquarters. For the next half hour, we're going to be breaking down the trends of the day that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Searching for a deal. That's the message. Inflation-weary shoppers are sending retailers. Some, like Dollar General, are cutting prices in a bid to lure folks, though the possible impact, of course, on the bottom line, spooking some investors today. And in short supply, weight loss drugs struggling to keep up with demand for GLP-1s, and patients are struggling to navigate the supply squeeze. One telehealth company is trying to make that easier. We have more on that coming right up. Plus, the impact of AI software stocks getting pummeled today after Salesforce reported record low growth in its recent quarter. Cloud companies are seeing a pullback on deal making this quarter. A slowdown, Brian Schwartz of Oppenheimer attributes to a shift toward AI spend. While the hype and investment around AI continues to thrive, a new study shows GenAI has done little to disrupt the existing balance in search engines. Google Gemini, according to search-focused marketing platform Soci, ranked the highest when it came to quality local searches, while ChatGPT, they said, coming in dead last. Here with more on the study's finding is Soci's founder and CEO, Afif Khoury. Afif, it is good to see you. So you basically, if you and your team, you kind of evaluated these new GenAI tools when it comes to local search specifically. Walk us through the study, Afif. What was your methodology here?
Yeah, thanks, Josh. Good to be here with you. So that's right. We were looking at how different AI tools compare in delivering really local search results is where we focus. And we analyzed 6 of the top generative AI tools. You had Google Search Generative Experience, SGE, Google Gemini, ChatGPT, Bing, Copilot, Perplexity, and Meta AI. So as you stated, Google Gemini ranked the highest due to consistent ability to provide relevant, detailed information, often supported by Google Maps, which is their product and that they push really hard to get updated. Bing Copilot also performed pretty well. Bing pulls a lot from Yelp, so it had a source that, again, often gets updated by local businesses, so they were able to offer detailed results. On the other hand, tools like ChatGPT kind of struggled with precise local searches, often providing results that were not location specific. I think the variation highlights the importance of business optimization of local sites and local sites that are really important. And it just shows us that the AI is only as strong as the data it has access to or that it prioritizes. Google has Google Maps, and there's a lot of great data there that businesses tend to update quite often. Bing had Yelp, and I think ChatGPT seems to be prioritizing some other information that's not as relevant for local searches.
Yeah, and that's where I wanted to go with you, because you think about the Google and Bing, for example. I mean, they are they're designed for this, Afif, right? For local search. ChatGPT, it isn't. I mean, Sam Altman, a man of tremendous ambition, we'll see what Sam has cooking in the product pipeline. But I guess my question to you was, is the study, is it fair in that sense, Afif? Are we kind of really comparing apples to apples, so to speak?
Yeah, I suppose, look, let's be fair. The spin on it may currently not be in favor of GPT in the sense that generative AI tools, they have access to the internet. So GPT has access to this local data as much as Bing or Google do, right? Because it's publicly found information. But it does come down to how they write their algorithms and what they prioritize. And Google has been in the local game for a long time and heavily prioritizes that data. So I wouldn't say it's unfair in that different companies have access to different information. But when you pick a certain topic, some may be better than others for that topic, depending on what they prioritize.
Do we know, Afif, how GenAI is impacting local businesses? I mean, do we have a sense of whether it's actually getting customers in the door and buying product? Any actual line of sight there?
The direct attribution is a little bit harder. Generative AI is significantly enhancing the local search capabilities in theory by providing more precise, contextually relevant results. The these LLMs are supposed to make it much easier to find things. Right now, you usually get a list of results, and then you got to go down each one and look for what you're looking for. By taking all that information and summarizing it, it really is supposed to put it right at your fingertips. So if you're looking for a Starbucks near me or a Mexican restaurant near you, these AI tools are in theory the best way to go aggregate all that information across reviews and social and search and many different areas and give you the answer to what's the best. We're in version 1, Josh. I think this is where everyone just has to remember we're in version 1. It starts with what data do we have access to? How well is it being optimized for that? Let's get to version 6 and version 12, and I think you're going to see a true and really strong impact. But I don't think businesses can wait for that. I think they'll fall behind if they wait for that version. While it's a little clunky now, they've got to optimize their data and be ready for that.
Afif, super interesting study. Thanks so much for joining the show today. We appreciate it.
My pleasure, Josh. Thanks for having us.
And coming up, patients are scrambling to find GLP-1s amid a supply crunch. Telehealth company Ro has a solution. We're asking for a trend on the other side. For GLP-1s, demand is not the problem. It's supply that has left thousands of patients struggling to find available drugs. Telehealth company Ro has a solution with a tracker that aims to make supply information more transparent and accessible. Co-founder and CEO of Ro, Zach Reitano, joins me now. Zach, thanks so much for joining the show. Maybe start, Zach, just explain a little bit to viewers who may not all be familiar, a little bit more about Ro, the problem you all are trying to solve for. And I'm interested, of course, also these GLP-1s. What's been the effect, Zach, on your business?
Yeah, happy to. Thanks for having me on, Josh. At a very, very high level, at Row, we are building goal-oriented healthcare. So we help patients achieve their healthcare goals in the most effective and convenient way. So patients come to us and they start with what they want to achieve. I want to have a child, and we have fertility services. I want to have better sex, and we have products for that. I want to lose weight, and we have high-quality obesity care centered around GLP-1s. And we deliver that really effective and convenient experience by vertically integrating the business. So we have a national digital doctor's office live in all 50 states. We own and operate our own CLIA certified and CAP accredited lab, and we have pharmacies distributed throughout the country. So again, it's that doctor's office, lab, and pharmacy, all through the lens of helping a patient achieve their goals. And over the last 6+ years, we've helped millions of patients, one in every single county across the US. We've been in obesity, as you mentioned. So we've been in obesity for about 4 years, have helped hundreds of thousands of patients start their weight loss journey, and have built what we refer to as the Row Body membership. And that is high quality obesity care centered around GLP-1s. And that's been around for 18 months. But as you kicked off with, there's been a massive shortage throughout the last 18 months. And that has resulted in us continuously building products and services to help patients manage through it, expanding our formulary. Again, as you said, demand has far exceeded supply across the country.
And I'm just curious, because you've been in this for a bit, Zach, demand for GLP-1s, what are you seeing? How strong is it? And any kind of line of sight, Zach, into where, in broad strokes, the demand is coming from that you all see, men, women, young, old?
All of the above. The U.S., I think this is actually a one-of-one situation when it comes to healthcare and the invention of a new drug. A lot of people are drawing different sort of historical analogies to either blood pressure medication or statins, and there are a lot of similarities to that. But never before in healthcare has the majority of U.S. population been eligible for a drug, right? So the U.S. population, about 75% of people have overweight or have obesity. This drug is incredibly effective. It's scalable. Patients desperately want it, and providers want it. So those 5 things have never existed before. And about 50 million people are covered for these drugs by commercial insurance, but 150 million people in the U.S. are eligible for them. So I think that we are dramatically underestimating the demand, and I think we're going to see that demand-supply mismatch for years. Now, Novo and Lilly, starting in 2022, probably through the end of this decade, are going to invest $50 to $75 billion to increase that supply. But again, when you run the numbers, when you look at how much is required and how many people are eligible, and the efficacy of the drugs and the breadth of the label is expanding every single week, we see new studies come out showing it isn't just an obesity drug, right? It's for cardiovascular disease and diabetes and sleep apnea and chronic kidney disease and more. So I think you're going to see demand outstrip supply for the foreseeable future. The challenges and what we built in terms of this trend of this GLP-1 supply tracker, a little bit about what the tracker does and why we built it. It is trying to help patients and providers crowdsource supply. Patients come on and say, I need supply, what drug and dose they need, and their location, their zip code. And people come on and say, I found supply. And when they do, we notify everyone within 100 miles automatically, that pharmacy, the address, the phone number, so they can call and transfer their prescription. And the second thing it does is it automatically notifies the FDA if the patient wants about their experience with the shortage in real time, to make sure that the agency has as much information about real life, real-time patient experiences as possible. The really interesting thing is this tool shouldn't need to exist, right? So we built it, we've seen tremendous traction, we've seen thousands of shortage submissions already just in the last 36 hours since it's launched. But inventory management, basic inventory management, is a solved problem in other industries, right? You and I could go to Best Buy. You said you're in the studio in New York City right now. You and I can go to Best Buy or bestbuy.com and see the Best Buys in New York. And it'll tell us if something's in stock, how many are available. Are there 2 or 3 available and I need to rush to Best Buy? If it's available for pickup, can I be on a notification list? And that should be the case at your local pharmacy. And the reason why that's so important, and I think that people hear about the shortages, and it's definitely, unless you've experienced it, it's hard to truly understand the severity of the problem. which is that it's essential for health outcomes that patients get continued access to their medication for chronic diseases, for diabetes, for obesity, for heart disease, for chronic kidney disease, for all of these things, this continued access. And so every single month, it's a hunt to find supply, and it really will negatively impact patients and health outcomes. And so both patients and providers are having a really hard time with this. So for us, we're trying to build around the system that exists. This tool shouldn't need to exist, but we're building it to increase access for patients.
Zach, it's a big, important topic, one consumers and investors care a lot about. Thanks so much for joining us.
Thanks for having me, Josh. Hope you have a great rest of your day.
You too. A potential change in the wind for stocks. Since October's low, stocks have seen strong breadth, but over the past week, there's been a slight shift to this narrative. What could this mean for investors? Julie Hyman has the answers, and she joins us now for a closer look. Julie.
Thanks, Josh. We've been talking about breadth a lot, right? That, when we talked about it even earlier in the hour when we were talking to Ed Clissold, that, Nvidia, some of the large cap tech stocks had been accounting for a lot of the gains. Breadth had started to widen back out. But in this chart brought to us from Bespoke Investment Group, we have seen breadth that has started to deteriorate really just in the last week. So what you're looking at here in blue is the S&P 500 index. Then in purple, you have the cumulative advanced decline line. On any given day, how many stocks are rising versus how many stocks are falling. And again, just in the last week or so, we've seen a bigger gap between these two lines. That indicates a little bit of a deterioration in breadth. Again, that, it's perhaps not as broadly based, the movements that we are seeing in the stock market. Traditionally, maybe that's not viewed as a terribly good sign. Another way to look at this potentially is to look at the S&P 500 equal weight index. You can see it's up 3.4% year to date. It's been trending down, but compare that with the S&P 500 itself, which is up almost 10% year to date. Just another way to sort of slice it here when we're looking at these breadth indicators and what they mean, Josh.
So, Julie, bring out your crystal ball. What does this mean about what happens next?
So according to the folks over at Bespoke, again, they point out traditionally it's not necessarily viewed as a good sign. If you look over the last 10 days, you have a net 83 stocks declining per day. And historically, that's a pretty low reading, a pretty bad indicator of breadth. But they say what you tend to see is so-called reversion to the mean. In other words, you do tend to see a rebroadening of stocks and stocks then going sort of in the same direction. And that can lead to stronger forward returns as those stocks that had lagged catch up. So that's what we mean by reversion to the mean. It's unusual to see this dispersion. So when they start moving back together again, that catch-up effect helps to then power stocks higher. So according to them, that's what could happen if history is any guide.
All right, Julie, thank you so much. Appreciate it. Let's move on. A jury has reached a verdict Thursday in the criminal hush money trial of former President Donald Trump in New York. Let's get to Yahoo Finance's Rick Newman. Rick, what do we know?
Not enough right now, Josh. We know there's a verdict and we don't know what it is. So this is the moment some people have been waiting for, but we're going to have to wait just a little bit longer. So I think it'd be foolish to make any predictions here. I think the one thing we know for sure, since this happened pretty quickly, is that it's not a hung jury. So it's not going to be a mistrial situation, which means either it's going to be guilty on some or all accounts or not guilty on some or all accounts. Just to remind people here, there are 34 different counts. It's 34 different counts because each of those is a particular bookkeeping matter. So there are all these different bookkeeping. And just to get back to the basics of this, Trump is not charged with paying hush money or with having an affair with a porn actress. Those things are actually not illegal. This is all about whether the way he accounted for it on the books of the Trump organization was a falsification of business records. So that is what the jury is deciding here and apparently has decided. And we will get this before markets open tomorrow, I guess, is the best way to look at it.
All right, we'll have a lot more to talk about. Rick, thank you, my friend. Appreciate it.
Yeah, man.
We're going to keep following the situation and get back to you when we do, of course, get a decision. Coming up, we're rounding up the top takeaways from a busy week of retail earnings. We're asking for a trend on the other side. This week, Wall Street heard from a slew of retail names providing a fresh look into consumer spending trends. Here with the details is Yahoo Finance's very own Brooke DePalma. Brooke, takeaway number one.
Good afternoon. Takeaway number one is consumers are still very much so focused on groceries.
They still want to eat.
They still want to eat, and they're still focused on spending their dollars when it comes to groceries. And we saw Costco just report after the bell. They beat on all metrics. This goes to show that groceries consumers are still looking for value. We saw membership fees also come in line with expectations, but that's up roughly 7.6%. So we're seeing more consumers flock to a company, a wholesale retailer, where they think they could get more bang for their buck. We saw it the past quarter in Costco. And on the flip side, Josh, we heard from Best Buy CEO this morning. He told Yahoo Finance on a call that consumers remain uneven, but she added that they continue to prioritize food, fuel, and lodging, all of which are more expensive compared to
pre-pandemic. It sort of is this broader theme we heard all earnings season of consumers feeling more cautious, more prudent, this kind of emphasis on, you know what, if I got to buy, I'm going to buy what I need right now, not what I want. Right?
Yeah, and also you see other consumers turning to experiential economy, and so they're really making that decision. Okay, where can I get the best bang for my buck, but also what exactly do I need?
So value.
And that brings us to our next point, value. So we heard from Dollar General today that they beat expectations for the fourth straight quarter, and they also did warn that they could experience a slowdown, that consumers are really looking for value, but they're also sort of tightening their wallet here. So on the call, the CFO said, our customer continues to be very value driven, and they do anticipate they will continue to see to be price sensitive as they move through the year. So really consumers being more prudent with where they spend and really perhaps turning to these dollar stores. We know Dollar General has a huge grocery business as well.
Yeah, I mean, it's interesting because not so surprising, Brooke, you have, we talk about this all the time, and you know it because you study retail so hard. I mean, consumers right now, inflation is still rising.
Yeah.
It's rising at a slower clip, but it's on top of 40-year highs. That is a real burden for a lot of Americans, and particularly middle income, especially low income. So you're not surprised, I don't think, to see this kind of commentary.
Yeah, and Dollar General also did note that their private brand sales, as well as that $1 price point, is performing so well for them. And that's because consumers are really looking, they're being more mindful of where they can get the best price across the store.
Yeah, it makes sense, right? Not to mention higher rates. You're trying to finance a new appliance, a car, a home, all this sort of weighs out,
Yeah. And the third takeaway here is we did hear from Kohl's this morning that they are seeing a bright spot in beauty. Now, believe it or not, you would think that consumers aren't spending on beauty, but Kohl's...
But what kind of beauty?
So
beauty.
So
I actually know what I'm talking about. I'm just hoping you do, because I don't.
Don't worry, I do, Josh. They're spending on skincare. They're spending on bath and body, fragrance. Those are some of the key drivers for Sephora at Kohl's. Of course, Sephora owned by LVMH, but we've seen Kohl's bring in that Sephora shop inside stores, and it's seeing returns. Sephora at Kohl's stores increased 60%, including greater than 20% comparable beauty sales growth and better than expected contribution from shops opened in just the past year. And so this is really bringing in, as Kohl's did not do well in this past earnings report. This was a bright spot for them. And then also, e.l.f. Beauty reported recently they saw exceptional growth. But on the other hand,
here it comes. Wait, today after the close,
Ulta Beauty.
Yeah,
Ulta Beauty, they posted an increase of 1.6% year over year. Now they did hint at a slowdown back earlier this quarter, but they're just not faring as well as these other beauty names. Some expect that they're seeing that slowdown earlier, while e.l.f. Beauty hinted at sort of a slowdown that could come. So it's really something that we're not seeing as of yet hit all the major beauty retailers, but something to keep an eye on for sure.
Ulta taking it on the chin.
Yeah.
I was trying to think of like a beauty metaphor.
That was good, taking it on the chin. I like that.
Brooke, thank you. Appreciate it. That is a wrap on today's Asking for a Trend. More Yahoo Finance next. Stay tuned. We are still live here on Yahoo Finance as the Trump hush money trial has come to a verdict. We are awaiting the decision, and we'll have that for you as it comes out. So big decision, Julie. We're waiting, of course, immediate questions about what it would mean clearly for the campaign, whichever way it goes.
Yeah, and there are some reports here that the decision came in, and then the jury had asked for 30 minutes. I guess there is a juror form, and there's some paperwork that they have to complete. So they've asked for 30 minutes to complete that form. So that would put an announcement of what the verdict is actually, what it actually is, in maybe 15 minutes or so, if we kind of extrapolate around then, or maybe a little bit less than that. So we'll keep an eye on that. Just a reminder here. The former president, Donald Trump, is facing 34 felony counts of falsifying business records. It's connected to this hush money payment that was made to Stormy Daniels, the adult film actress, shortly before the 2016 election. Now, as we've talked about and folks who have followed the case know, it wasn't the payment necessarily that was illegal. It was the alleged cover-up of the payment. And so that now is what the jury has come to a decision on, and we'll find out about it.
I feel like they came to a decision pretty quickly, and of course we have the great Rick Newman on standby, ready for all.
We do.
Insight.
Yes, so we'll be figuring out what the potential implications of this are. In the past, some of these legal troubles for Trump have been an opportunity for him to do some fundraising. So we'll see what happens in this particular case. Undoubtedly, if it is indeed a guilty verdict, he will seek an appeal of that verdict. So, but there are a lot of questions here as we await what this verdict is and what will happen next. An unprecedented situation here that we are awaiting at that Manhattan courthouse.
For sure. All right. Well, while we wait for that decision for the Trump trial, let's take a look at a few trending tickers. Shares of Nordstrom, let's start there. They are falling here about 6% after posting a wider than expected loss for the first quarter. Adjusted loss per share, 23 cents. Adjusted EBITDA, also mixed expectations. Adjusted EBITDA, 117, Julie. That was down about 34% year over year. The street was closer to 150, so that's a pretty good miss. Total revenue, $3.34 billion. That was actually better than expected. That popped about 5% year over year. Street was closer to $3.2 billion, but clearly investors disappointed here.
Yeah, and the company also leaving unchanged its forecast for the full year here, even after the numbers beat. Maybe that's part of the disappointment. It's a pretty broad range, though. The company says full year revenue will fall 2% to rise 1%, and sees margins for the full year, EBIT margins of 3.5% to 4%. We have talked a lot about how the consumer is doing right now. Nordstrom is seen a little bit as the upper end of the spectrum of department stores here, although, of course, they have the Nordstrom Rack business as well that caters to the lower price point. And the company CEO, Eric Nordstrom, saying, indeed, profitability fell short of their expectations. And they do say they have momentum heading into the rest of the year and the confidence to reaffirm the 2024 guidance, so sort of acknowledging that little bit of a disconnect.
Yeah, it's trying to sound somewhat of a confident tone. The street not as confident. I mean, not a whole lot of conviction on this name if you just look across financial analysts. 3 buys, 11 holds, 5 sells, Julie.
Yeah, and then we're also watching chipmaker Marvell Technology. That company missing Wall Street expectations for first quarter revenue. They were hurt by weak client spending in the wireless carrier and enterprise market. CEO Matt Murphy saying, we see a favorable setup for the second half of this fiscal year. The company forecast for second quarter revenue was in line with what analysts had been anticipating. But Marvell shares are down about 4.5% here. And the company's second quarter adjusted earnings per share forecast, 24 to 34 cents. The estimate was for 28 cents. So sort of in line-ish there with what analysts had been anticipating.
Yeah, data, I'm just looking through some of the numbers. The CEO calls out, by the way, the start of a ramp in our custom AI programs, complementing our substantial base of electro-optics revenue. Looks like data center end market revenue rose about 87% from a year ago, according to Marvell. Compares with 54% year-over-year growth rate in the fiscal fourth quarter, but stock down, at least right now, in the after hours initially.
Yeah, the shares are up about 27% here year to date going into this. So this is one, that's done pretty well here running into the print.
Yep. Executives saying we see a favorable setup for the second half of this fiscal year driven by continued growth, data center beginning a recovery. They call out enterprise networking and carrier infrastructure. We'll see how it shakes out after the call.
Okay. And then we're also talking about Apple, a story that we're watching.
Of course. Apple reportedly planning an AI-based Siri overhaul. This is according to Bloomberg. The move by the tech giant will allow Siri to make commands of all the features within apps, one small step from Apple towards its larger AI strategy. So, this, of course, has been a big issue we've talked a lot about with our colleague Dan Howley, who's been all over this, and all the attention for Apple now. Really, if you're an investor, you're all looking forward now to the big software event in June, WWDC, and what they're going to announce. The expectation is that Tim Cook and Craig Federighi will take the stage and announce some very slick new AI features. And it sounds like when it's reporting, that's going to include a nice overhaul for Siri.
I'm seeing a headline about the verdict.
Let's get it.
But I don't know if the team has seen the headline about the verdict.
If you've got the headline, you go with it, Julie.
I've got the headline. Okay, I guess we're not going to do it yet. We're going to wait.
Not yet.
Okay. All right, let's take a break.
Yet. We are awaiting the decision of the Trump hush money trial. I'm going to get you that when it comes out. Stay tuned, more Yahoo Finance on the other side.
We now have the verdict in the Trump hush money trial. The jury finding Donald Trump guilty on all 34 counts here, those stemming from the 11 invoices, 12 vouchers, and 11 checks that were his reimbursement payments to Michael Cohen. Let's get to Yahoo Finance's Rick Newman now, who has been, of course, tracking this very closely. So, Rick, guilty on all 34 counts.
I'm surprised, to be honest. This case, according to legal scholars, who I am not, it said it was not a slam dunk. I mean, they had to make this somewhat complex connection between the bookkeeping entries and whether this contributed to election fraud, which was actually not one of the charges So the jury wrapped this up pretty quickly, guilty on all accounts, no daylight. Now let's remind people this means unanimous, all 12 jurors agreed on this. And Trump is now a convicted felon. We know that Trump is going to say this was rigged, but it's not easy to get 12 people, even in New York, so-called liberal city of New York, to agree on something like this that's kind of complicated and not automatically intuitive. So apparently the prosecutors made a great case. There are a lot of questions about the defense, some of the tactics of the defense, which some experts said seem designed more to please Donald Trump than to actually win the case. But now we have an outcome, and it's not over. Trump is almost certainly going to appeal. This whole thing will not run its course by Election Day in November, but this is a big moment.
Let's bring in Henrietta Trace here now to Aveda Partners, managing partner and director of economic policy research. Henrietta, it's good to see you as well, and maybe just get your response, Henrietta. Rick there expressing some, a bit of surprise, I think, at the verdict. What do you make of it?
It's certainly shocking to see all 34 potential crimes actively confirmed guilty by this jury of 12. I don't think that the former president can run away from this. I'm particularly concerned and have been throughout this entire process about your suburban enclaves. This is the area that Biden won the election on in 2020, and they have shown substantial resistance to Donald Trump throughout this entire primary season, most recently just in Indiana, where they gave 22% of their vote to Nikki Haley, who, of course, dropped off the ballot 2 months ago. This is a searing referendum against former President Trump, and I think will be an uphill battle for him to win back suburban voters that he has lost since 2016, as has the Republican Party. So I think this is a pretty searing indictment on him on every single count. I thought at worst, it would maybe be split on some of them, not all coming back guilty, but watching them be read like that is the worst case scenario outcome for Donald Trump.
I want to go back to Rick Newman for a moment. And just to linger on this, to be clear, this is the first former president of the United States who has ever been convicted of a felony. As you said, Rick, the former president is expected to appeal this. But presumably, could sentencing come before that? In other words, could he end up serving jail time as he puts together an appeal?
Probably not. There are a lot of different ways this could go. So if you get convicted in a trial like this, the judge can put you in jail, and then you have to post bond. The analysis I've been looking at suggests the judge in this case is very unlikely to do that. That would probably seem to be unnecessary. It does matter that Trump, number one, this is not a violent offense, and number two, Trump has never been convicted of a crime before, so he sort of gets first-time offender privileges. So I don't think we're going to see the judge doing anything like that. But there will, so there will be a sentencing, and then there will be appeal, and this is going to go on for some period of time. It's not over, and we don't know how this is going to affect Trump's chances in the election. I mean, on the surface, you would think it certainly can't be a good thing if you get convicted of 34 crimes. But this is Trump world, and this is, 2024, and it's a little bit of like upside down time. The one thing I think it's worth keeping in mind is most Americans have not been following this trial. They're not glued to it the way we are in the media. They will hear something about it for sure, and they might say to themselves, oh, isn't this about the hush money thing? Don't we know all about that? What is there really anything new here? And of course, Trump has proven that he is able to turn all his legal problems into fundraising bonanzas. So at some level, he seems to get more support when he loses in court. Now, this is a conviction. The others have only been charges up till now, so this could be different. It's just going to be fascinating to see what this does to the presidential race.
Yeah, Henrietta, let's get you back here on this point, because what about the argument, Henrietta? And I'll make it. And listen, you're the pro, so you tell me. I don't see, Henrietta, how this has a big, meaningful political impact. I mean, we all know Trump. He has been a central player, actor in our national stage for years. It just is hard for me to believe, Henrietta, that people who are voting for Trump or thinking about voting for Trump, and you look at the swing states, the polling shows they're all favorable to Trump. I don't care which one you look at. You think, Henrietta, that a lot of those people now say, well, wait a minute, you know, a New York City jury said falsified business records, that's it. That is the final line, can't do it. I mean, really, Henrietta?
I'm certainly not the person making the incredible arguments that y'all are, except for to say that we have numbers to back it up, to think about how this is going to impact voter opinion. And the stats that I read out before were reality from actual elections. So
yeah, I know we have the polling, Henrietta, but it's just, I get the data and the polling, but something about it, I got to be honest, it doesn't seem right to me. It doesn't seem like it makes sense to me that some people would say, they've known this guy for years, they're going to vote for him, and falsifying business records is now the reason they say, I'm out. I mean, I know we have the data, but don't you think it just sounds kind of weird?
There's about 28% of voters who are open to changing their opinion based on a guilty verdict. And so to walk through some of the data that's available is to look at the disparity, as I mentioned, suburban voters. If you look at the polling and the incredible amount of consistency, does this court case matter? Do any of these convictions matter? For most of Americans, it does not, except there's 23% who are open to changing their opinion if he is found guilty. And that's been in poll after poll. And what you want to look at when you see the polls, as you mentioned that Trump is ahead in the swing states, that's true, but only if you're including all registered voters. That includes youth voters, minorities, and specifically young men. And those voters do not turn out. Indeed, they are less than 5% of the electorate in the 29 and under cohort. So what you want to focus on if you're thinking about prognosticating about the election is how does this impact the voters who will have their mind changed and who are actually going to vote. And in each of those, across Pennsylvania, Michigan, and Wisconsin in particular, Biden does materially better if you ask about likely voters. Those are your suburban, college educated or more educated, more affluent voters, and they make up the bulk of the electorate, including those over the age of 65 who now have trended away from Trump and towards Biden. This is the first election cycle where Democrats are winning in the 65 and up cohort. So the people who are open to being impacted by this are, in fact, your more educated voters. And they are the ones who are following this. And 28% of those say that they are open to changing their mind if there's a guilty verdict. To be clear, I don't have a dog in this fight. I'm not on the campaigns. So I just want to stress that at the outset. But there is a good portion of the population who is paying attention to this. Trump has the exact same number of supporters he did in 2020 as he does today. And what this court case will potentially do with 34 straight guilty convictions is compel those voters in the suburban districts who have a higher propensity to vote to say, you know what, this is not my guy. Wasn't my guy in 2020. He's not my guy in 2024 either.
Desperately wants to make this election a referendum on Trump, make Trump the issue rather than Biden the issue, and get voters to forget about inflation, forget about food prices, and their paycheck doesn't buy as much as it used to. My question is, does this alone get that done for the Biden administration? And will this last all the way into October when people are finally deciding whom to vote for?
No, I imagine it won't. We are months away from the election. 24% of the electorate does not even decide how they're going to vote until after Labor Day. So this is all happening very quickly. Obviously, it's Thursday night, as y'all in the media cycle know. It'll carry the news throughout.
Henrietta, hold on. We're listening now to what Trump has to say.
It's a rigged trial, a disgrace. They wouldn't give us a venue change. We were at 5% or 6% in this district, in this area. This was a rigged, disgraceful trial. But the real verdict is going to be November 5th by the people. And they know what happened here, and everybody knows what happened here. You have a Soros-backed DA and the whole thing. We didn't do a thing wrong. I'm a very innocent man, and it's okay. I'm fighting for our country. I'm fighting for our Constitution. Our whole country is being rigged right now. This was done by the Biden administration in order to wound or hurt an opponent, a political opponent. And I think it's just a disgrace. And we'll keep fighting. We'll fight till the end and we'll win, because our country's gone to hell. We don't have the same country anymore. We have a divided mess. We're a nation in decline, serious decline. Millions and millions of people pouring into our country right now from prisons and from mental institutions, terrorists, and they're taking over our country. We have a country that's in big trouble. But this was a rigged decision right from day one with a conflicted judge who should have never been allowed to try this case, never. And we will fight for our Constitution. This is long from over. Thank you very much.
That was former President Trump, who now becomes the first president ever to be convicted of a felony, all 34 counts. Former president was convicted in a New York court, and just making some comments there, unsurprisingly talking about how he is going to fight that verdict. Sentencing, I'm seeing now, has been set for July 11th. Now, whether he will be, as we discussed, sent to some kind of detention following that as he does appeal, probably unlikely, but nonetheless, that's when the sentencing will be happening. So just an unprecedented, historic day as we look at the outcome of this trial. We've been speaking with Henrietta Trays of Veda Partners, as well as our own Rick Newman. Henrietta, I wanted to take it back to you because as you talked about, and as we have talked about, this won't necessarily dent the true believers. It might hurt some of his standing along with swing voters. I am very curious what this does, if anything, to some of his high-profile donors. I'm thinking of the Steve Schwartzmans of the world. I'm thinking of the report that I saw today that Bill Ackman was considering supporting Donald Trump. Now, you know, these folks are businessmen, right? They have become perhaps more ideologically aligned with the Trump presidency. But does this sway people like that at all?
I sincerely doubt it. I think it's really notable that they were very aware that this verdict was coming, and they probably knew it was coming today or tomorrow, and they have actively gone out to rally behind him, as did Nikki Haley, for example, and all the rest. So I think he's been building up his donors, and at least some of these 35 counts were going to come back guilty. I think it's the base case expectation for all of them to come back guilty, as I mentioned before, is the worst case scenario that I could have envisioned for Trump. So I don't think he will lose any support from the high dollar donators, obviously Elon Musk. But I would note, and this is something I talk about with my clients just recently, Trump outraised Biden in the last month of the election cycle. And it's really important to look at where those donations come from, because everybody in America only gets one vote, no matter how many dollars they give to Donald Trump. So we saw this with Ron DeSantis, for example, during the primary season. He was able to get tons of money in $196 million, but just from a couple of donors, big ticket donors. In Trump's case, for the month of April, which was his record fundraising haul, those donations came from 18 people at one event, $50 million worth. So he does have these mega donors, but he does not have the small dollar donors. And again, everybody gets one vote no matter how much money you give. And that's really important to think about here from a donor perspective, and contrast materially with Joe Biden, who is getting about 45% of his donations from small dollar donors versus 31% from Trump.
Rick, let's bring you back in here. We did just hear from Trump. Strong response. This was rigged, he said, a disgrace. The real decision, he notes, is coming in November. Said he's an innocent man. This is Biden trying to hurt an opponent. What did you make of those comments?
Well, just a little fact checking on that uplifting rhetoric we got from Trump there. He said Biden did this. This is Biden going after him. This is not the federal government. Biden actually has nothing to do with this. They've used some evidence from the Michael Cohen trial, which the Justice Department prosecuted when Trump was president. But this is the New York City district attorney. It literally has nothing to do with the Biden administration or the federal government. So again, just basic things for people to keep in mind. I'd like to ask another question and maybe bring this back to Henrietta. I wonder what Biden can do to take advantage of this. Now, there's been all this discussion about will Biden start weighing on this, trolling Trump in some way, or figuring out how to use it to his advantage. I wonder if, going back to this question about the donors and just about centrist voters who are the real swing voters here. A lot of people have been waiting for Biden to move to the center, which is what, a Democratic candidate might typically do in a presidential election. He hasn't really done that. He hasn't said anything, for example, about the border problem, which Trump just referenced. Is there something Biden can do, Henrietta, to exploit this at a policy level rather than a personal level, mano a mano with Donald Trump?
Yeah, I think the first thing the Biden administration should do is point out that over month, immigration is down more than 50% at the border right now. And that is a 3-month-long running trend from February. You'll probably recall that we've been waiting for an executive order from the administration on immigration, especially since the Senate has not been able to pass its bipartisan immigration reform bill that would diminish migration at the border. But the reason that the Biden administration hasn't had to pass any asylum executive orders is because the border is being so adequately controlled at this exact moment. They are at 3 consecutive running months of decline, 52%, I believe, 56% in the last month alone. So I think if the Biden administration could get out and actually speak to some of the gains in the Dow, the fact that inflation is amongst the lowest in the world, get any of their messaging across would be a huge boon. Indeed, I think this is one of the major reasons the Biden administration decided to put a debate on June 27th so much earlier, 3 months earlier than it's usually held, is because they literally are not breaking through to these undecided or moderate voters. The reality is that most voters have a disapproval rating that's well underwater of both of these men. And Biden needs to really get out into the center. Being anti-China, putting 100% tariffs on electric vehicles is very promising for, or very well received by the swing states in the Rust Belt area. The declassification of marijuana is another one, and I expect Democrats would focus on, for example, the extreme legislation the Louisiana legislature just passed on basic miscarriage medicine that's used in 63% of abortions nationwide. So I think there's a lot of things they could point to. I don't think those are necessarily overly leftist, and they have some really good news that they could use on the immigration front to combat the #1 talking point that Trump just came out with himself to use as his rationale for reelection.
Henrietta, finally, we're showing scenes outside the courthouse. There obviously a pretty big police presence. Trump has a lot of supporters in the streets. We showed some folks who were anti-Trump as well. Any concern about civil unrest in the wake of this verdict, do you think?
I hear that all the time. I hear it just casually on the street. I live in Louisiana, and I hear it, down in the Gulf of Mexico this weekend. People very concerned that the November 5th election will result in massive civil unrest. That is something that Donald Trump is actively saying will occur should there be an election that he doesn't win in November. So I think that is something that registers. When you see it on the polls, it's the question of what is the state of democracy? That's how the question is phrased. And that could be any number of things. It could be, are you on the side of the January 6th insurrectionists? And do you think that they are patriots that are being imprisoned against their will? Or do you think Donald Trump fomented an insurrection on January 6th? It really is an all-encompassing concern for Americans across the country. And like I said, I hear it all the time from casual observers who maybe do not want to be swayed or will not be swayed by the outcome of this election. They're very concerned about civil unrest. And I think you see that in every state nationwide.
Henrietta, thank you so much for jumping on and reacting to this historic verdict. Really appreciate it.
Thank you.
Just want to get a couple of closing thoughts here from our Rick Newman. And by the way, guys, what we've been noticing is that the sort of market proxy for Donald Trump himself, Trump Media and Technology Group, ticker DJT, has been trading sharply lower in the after-hours session. It still is higher than it was when the trial began, but still taking a hit here as it is, again, sort of a proxy for Trump himself. Rick, you've been covering politics for a long time. We've never seen anything like this before, including, by the way, having a publicly traded company that's a proxy for a presidential candidate. Give us sort of your big picture thoughts here as we try to digest this.
DJT, the Trump Media Group, is a binary bet on whether Trump is going to win the election or not, because if he doesn't win, Trump's political career is basically over. It's the end of the road for him. And then what is the point of his social media company, which is way smaller than any other social media company out there, has hardly any revenues and is losing money. So you could expect that company almost to go bust if Trump doesn't win. In terms of the broader picture here, here's the setup, guys. Trump is going to be sentenced for 34 criminal convictions 4 days before the Republican convention at which he is likely to be nominated as their presidential candidate. I mean, it is surreal, but it has been surreal since Trump came down the elevator and announced his candidacy in 2015. So Trump has brought us into territory we've never been before. He did it again today, and this might not be the last time. So there could be more coming. Just get ready for it.
You know, we do have a statement here, Rick, from Biden-Harris campaign. They say in New York today, we saw that no one is above the law. They say the threat Trump poses to our democracy has never been greater. That is sort of central playbook, right? They've been hammering that theme, Rick, right? January 6th, January 6th. It hasn't broken through yet. If you look at the polls, do you think today changes that?
I want people to keep in mind that this was a jury trial. You have to get 12 people to agree that the person either committed crimes or did not commit the crimes, and we got 12 people to agree. Trump is going to complain forever that this happened in super liberal New York. But look, the defense got to, have its say about who the jurors were. And they did not take very long to find Donald Trump very guilty. And this was not a straightforward case. He is facing 3 other cases that are more serious than this, would have more serious penalties if he's found guilty, and in some cases are more clear cut. So Trump faces a lot of trouble. If this is a test of how he's likely to fare in a jury trial, it is bad news for Trump's future.
Rick Newman, thank you so much for giving us your thoughts, your perspective, your reaction to this verdict. Appreciate it.
See you guys.
And just to recap once more what has happened on this, again, historic day here. We have the first president ever having been convicted of a felony. Donald Trump, former president of the United States, convicted of 34 counts of falsifying business records in the first degree. Now, under New York state law, the sentence for that could range from probation to 4 years in prison, and sentencing has been set for July 11th. The president has said former president has said he will be fighting this verdict. Undoubtedly, he will appeal, but as it stands, that sentencing going to be on July 11th, and we'll see what happens.
Big moment, big questions about the fallout for the campaign, for sure.
Yes, most definitely. Thanks for tuning in. That'll do it for today's Yahoo Finance. Be sure to watch tomorrow morning, 9 a.m. We will continue to cover the conviction of former President Donald Trump. Have a good night.